Welcome back, everyone. In this video, I'm going to be going over an important discussion in the dividend community, and that is what is the better dividend ETF for monthly dividend investors, whether that be the JP Morgan Equity Premium Income ETF known as JEPI or the JP Morgan Nasdaq Premium Income ETF known as JEPQ. So I'm going to be going over both of these ETFs, breaking them down, speaking about their holdings and their investment methodologies, and maybe come to a conclusion which one you should buy. So first on this list is going to be JEPI, the JP Morgan Equity Premium Income ETF, and the current 30-day SEC yield is sitting at 8%, which is a pretty good dividend yield, all things considered, especially among covered call ETFs. It is a great ETF for people that not only want high dividend income, but people that also want to preserve their capital over time as well. And the expense ratio isn't too bad either, sitting at 0.35%. For the investment methodology of JEPI, the objective is to construct a diversified, low volatility equity portfolio through a proprietary research process designed to identify over and undervalued stocks with attractive risk return characteristics. Now, this is very important because this isn't simply an ETF that tracks an index and then sells covered calls on that index. This is an actively managed fund, so they select stocks which they believe offer low volatility and are also undervalued based on their risk return characteristics. And the ETF also generates income through a combination of selling options and investing in US large cap stocks, seeking to deliver monthly income from associated option premiums and stock dividends. So as you can imagine, the intent of both of these ETFs, whether it be JEPI or JEPQ, is to deliver income to investors. And it does that through two ways, at least JEPI does. It gives you income through the premiums of those options and also stock dividends. And the overall intent is to deliver a significant portion of returns associated with the S&P 500 index with less volatility in addition to monthly income. Now, this is very important because it isn't designed to track the S&P 500. It's simply designed to deliver a significant portion of the returns of the S&P 500 with less volatility in addition to monthly income. So technically, if the S&P 500 is up 10% for the year, and this ETF is up 7% with those dividends reinvested and offering less volatility, it is following through with its objective. It isn't just to provide high capital returns. It is doing what it is designed to, which is provide a significant portion of the returns of the S&P 500. Now let's take a look at JEPI's top 10 holdings. And this is very important because a lot of people that buy JEPI, they hear that the ETF is designed to capture a significant portion of the returns of the S&P 500. And they believe that this ETF holds very similar stocks to the S&P 500. And that is not true at all. Of course, as I said previously, this ETF selects stocks based on active management. So they look for stocks that are undervalued and also are less volatile. So top 10 stocks here, of course, is not like the S&P 500 at all, whether that be the top 10 holdings or the percent of net assets. So you have Nvidia, Train, Meta, Progressive, MasterCard, AbbVie, Southern Co., Amazon, ServiceNow, and Microsoft. Now, some of those stocks or companies certainly do reside in the S&P 500, but the weightings are completely different. And again, it's important to remember that this ETF doesn't really try to capture what constitutes the S&P 500. It's designed to have less volatility and also select undervalued stocks based on the metrics that they use. And as discussed previously, JEPI provides income from both dividends. Approximately 1 to 2% of the income you receive is from dividends, and then 5 to 8% of the income you receive is from options premium. And this option premium really helps enhance the income of this ETF, especially in higher volatility environments. And that is also going to be very important when we talk about JEPQ. And let's take a look at the dividend history here. This ETF pays at the beginning week of every single month like clockwork. This is a great income ETF for people that want a monthly income, of course. That's part of the reason why these ETFs are so popular, because it offers monthly income at a pretty high dividend yield overall. And you see that this dividend does jump around quite a bit, and there's really no forecasting how much dividend you're going to get paid because it is completely dependent on market volatility. In a highly volatile market where the stock market is going up and down a lot, you are going to get a higher dividend. And if there's not as much volatility in the market, you are going to generally get a lower dividend. And that tracks directly back to this fund page here. Higher volatility environments have allowed for more potential for options premium, while lower volatility environments may deliver less options premium. So again, higher volatility environments, great when it comes to income for this ETF, and it really helps people not be so concerned about market volatility when the market is going up and down, because they are getting paid a substantial dividend when it does. So let's jump right into JEPQ, the JP Morgan Nasdaq Equity Premium Income ETF. And based on the name of this ETF, I'm sure you can understand what this ETF does. It is very much based on the Nasdaq index, whereas JEPI is not based on necessarily any index, and it doesn't even have something like a Nasdaq or S&P 500 in the name because it doesn't select stocks based on that criteria. This ETF, of course, is quite a bit different. The ETF offers a 30-day SEC yield of 12.42%, with an expense ratio of 0.35%, so right in line with the expense ratio of JEPI, but offers a significantly higher dividend yield for the most part, at least at this 30-day SEC yield of 4% more than JEPI. So the objective of this ETF is to seek to deliver a significant portion of the returns associated with the Nasdaq 100 index with less volatility, which does sound quite a bit similar to JEPI, but once we get into the holdings of this ETF, you'll understand that this really is more so of an index tracking ETF rather than JEPI. So it generates income through a combination of selling options and investing in US large cap growth stocks, seeking to deliver a monthly income stream through associated option premiums and stock dividends. So there is quite a bit of similarity with the overall approach to both of these ETFs, but it is important to consider there's no metric to select over or undervalued stocks, right? So this pretty much just invests in US large cap growth stocks, whereas JEPI, they try to select stocks that they see are undervalued and that offer less volatility overall. It constructs a long equity portfolio through proprietary data science driven investment approach designed to drive portfolio allocations while maximizing risk-adjusted expected return. So basically, they're trying to provide an ETF with great returns, but also at the same time, lower risk when compared to the overall index when it comes to volatility. Jumping into the top 10, you definitely do see a higher correlation to the index that it tracks, which is the Nasdaq. So you see Nvidia, Apple, Microsoft, Meta, Amazon, Google, Broadcom, Tesla, and Netflix. And the weightings are much higher. This is going to be a much more highly concentrated portfolio. Remember, looking back at JEPI, none of the holdings really went over 2% in the top 10. But if you look at these, pretty much the top 8 holdings are all above 2%. So this is going to be a much higher, much more concentrated ETF when it comes to the portfolio overall. And this operates pretty similar to JEPI in that it gets some of the returns from dividends, about 1%. Of course, this is a bit less than JEPI because the Nasdaq doesn't really have as many stocks that pay higher dividends. And then also it gets 8 to 10% of the income that you receive from options premium. And of course, it has that same caveat where higher volatility environments deliver more income to investors. So why does this ETF have such a much higher dividend yield for the most part than JEPI? And that is simply because of the overall holdings and what it invests in, and that is US large cap growth stocks, which have quite a correlation with the Nasdaq itself. And these stocks generally do, of course, exhibit higher volatility than other stocks because of their growth characteristic. The Nasdaq itself is somewhat of a growth index, although it's not really marketed that way because it technically really isn't a growth index, but it does have currently a lot of growth stocks in it. And a lot of these growth stocks do provide more volatility overall, which enhances that income you receive from that options premium. And this ETF is also a lot more heavily concentrated to those holdings, where remember, JEPI, they select stocks that really aren't designed to be volatile. They try to find undervalued stocks and stocks that offer low volatility compared to the overall market, while this ETF does not. And just like JEPI, the ETF does pay the first week of every month. And you do notice that this dividend generally is higher than JEPI. And of course, that is because the volatility of this ETF, or at least the holdings that this ETF has, are more volatile, which enhances that options premium. And finally, I try to provide an answer to the question, what is a better dividend ETF, JEPI or JEPQ? And it really comes down to your portfolio already, or what you're looking for. If you have a portfolio with SCHD, it's possible that you might want to have something like JEPQ, because SCHD doesn't really have any of the Nasdaq holdings. They're not really growth stock orientated. They have dividend paying stocks. So I would pair and have no problem with pairing SCHD with JEPQ. And I also personally, of course, have no objection to pairing it with JEPI either. But JEPQ would make a great holding in addition to SCHD. Now, I don't own JEPQ because I already do have a significant portion of the Nasdaq covered. I own QQQ. So if I were to own JEPQ, then I'm just double exposing myself to the Nasdaq itself. Now, there are a bunch of other ETFs that you can pair with JEPQ, and it's basically dependent on your risk tolerance. You can pair VIG with JEPQ, you can pair, like I already said, SCHD with JEPQ, you can pair VYM with JEPQ. JEPQ is a great ETF to pair together with many dividend ETFs because JEPQ provides an extremely high income, but it also doesn't have any of the other holdings that a traditional dividend ETF will have, like SCHD or VYM. Now, on the other hand, JEPI would be a great addition to somebody's portfolio that already does have something like QQQ, which tracks the Nasdaq, VUG, which tracks growth stocks, or any other kind of growth ETF out there, like SCHG, which is the Schwab growth ETF there. So this really comes down to where your portfolio is, and do you want that added risk that JEPQ provides if you want to have also that higher income. It's an important kind of thing to consider. Me personally, if I were the 2 ETF investor that wanted a little bit more risk, pair SCHD with JEPQ. There's also no real reason why you couldn't also pair JEPI with JEPQ. Their holdings are not really similar at all, and it would really give you great income overall. Please remember, if you did enjoy this content, give this video a like to get this content out there to a wider audience. It would be greatly appreciated, and also consider subscribing to keep up to date on future content, and I will catch you all in the next video.